What do you think bond traders are telling us right now in the markets?
Well, I think that if you're referring to what's happened in the US Treasury market, what they're telling you is there's an increasing risk of inflation. I think that the view that inflation goes higher through the middle of the year, especially in the US, but in other countries, I think that's now pretty much baked in. What's more important, two other things, is will it stay with us? In other words, do we go above the Fed target and stay there? And the other thing is, if we adjust on yields, what will the world look like if those yields move very, very quickly? You know, a slow adjustment, say that we had, what was it, 1.6 on the tens, that's okay. A very quick one, maybe less so. So maybe what the bond market was showing was is something of a, just a little scenario of how things might be if the yields move quickly.
So if indeed we've got inflation expectations building, there are certainly expectations for better economic recovery as the vaccines roll out, and fiscal policy under President Biden is more expansive than previously thought. Where should the 10-year yield be right now?
Well, that's a very good question. You know, we've looked at it from many different angles. You know, on the equity side, you know, there's this very traditional way of looking at things called value investing. If you apply similar principles to the fixed income market and where the treasury yield should be, the number is quite a lot higher than 1.5. You know, if you have nominal GDP growth in the region where we're going to see it, and if you see inflation back at 2%, certainly you need a percent or so additional on the level of the tens compared to where they are today. But you know, this is a difficult thing to quantify in those terms because that's a very long-term way of looking at things. We know the market has got this whole thing called quantitative easing hanging over it, and the Fed's in play. So that makes it tough to call. But a normalized level of yield would be appreciably higher compared to where we are today.
If you are a bond investor or someone with a diversified portfolio with a component of bond allocation, what do you do?
Well, right now you need to be what I always call left of center. So you're like keep your duration lower than where your benchmark is. You know, so you know, if the curve keeps steepening and inflation remains in the system, we're not calling for hyper or anything like this, just a normalization. You do need to have sort of exposures like 2 to 3 and not much more. Credit is still okay. Emerging market dollar hard currency paper is probably still okay, but just keep your duration lighter than you would have had otherwise.